All right, so we had kind of a second down day, if you can call it that. Again, it's kind of hard to be too bearish when we're this bullish. But in today's video, I'm going to detail the process of how pullbacks emerge, of how intermediate pullbacks emerge from such strong bullish moves. For those that are expecting significant pullbacks because of how bullish we are and how crazily bullish we are, you may be a little disappointed. So I'm going to break that down. I'm also going to break down what's driving this price action today from these different asset classes. Kind of an interesting pattern, but not a surprising pattern. And then finally, today's trade idea looks at a setup for a stock that while the rest of the broad market may grind, there's a setup for a stock that's got a potential to really make a big move one way or the other. And so today's trade idea gives you alternatives of how to trade that. So let's go ahead and get started. Today is Thursday, January the 25th, 2018. This is the Market Outlook video from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that found this, that are watching for the first time. Keep coming back for more day after day. Subscribe to my YouTube channel by clicking that red subscribe button right down there below the video. You can do that right now while you're watching. Also, while you're down there, click that thumbs up icon right next to it. That lets me know two things. Number one, it lets me know that you liked today's video, that you got something out of it, some value out of it. Number two, it tells me that you want me to do the video again tomorrow. Scroll down further, comment on anything that stood out to you from today's video. What did you learn? What did you get out of it? Let me know by commenting. Finally, in the description, I've highlighted a link to join my daily email list where I send out, there's like over 4,000 of you, where I send out an email every day with a hyperlinked timestamp summary of everything we talked about, so you can get to what you need quickly, as well as a list of all the clusters, all the overbought and oversold stocks that are in the S&P 500. So make sure you sign up for that. Follow me on Twitter for more content in addition to these videos. You'll see my address up there, at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. That's that you'll see on that address. Finally, join the Market Outlook community on Facebook. There's a link down in the description below that will take you there, so you can join. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. And you can see, again, not a down day today, almost, but not a down day, but it was a filled-in candle, which means we closed lower than the open. So we opened up higher than we closed yesterday. We closed lower, though, than where we opened, and so that's why it's still filled in. And so not a bearish candle, but not a bullish candle either, and still still got that potential for that rollover to these Fibonacci support levels, the blue ones, which coincides with the blue line. The green ones coincides with the green line, and the orange ones here coincide with the orange line. The momentum line moves too quickly, it doesn't matter. So, but again, the near-term line's above 50 again. So again, even if we discount this day here, because we're so close, we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 days now. Remember that period back here last year was 20 days up above, and we were at the end of a intermediate cycle. So it's almost like we're getting this kind of one last hurrah. We had some good bullish impulse moves starting off the intermediate run. Then we started to get that near-term volatility, and it's almost like, just one more last irrational hurrah to push us up to these nosebleed highs. So that's kind of where we're at right now. Of course, 17 can turn into 20. 20 can turn into 25. Like, records are meant to be broken, right? You hear that a lot in the sports world. So we don't have to pull back right now just because we're up. It's almost like the roulette I mentioned before. You've landed on red 17 times. It doesn't have to land on black the 18th time. It's got the same odds, 50-50, of landing on red again an 18th time and then the 19th time. So it's the same thing here. It doesn't have to come down just because it's gone up so much day after day after day. But the odds of it coming down are starting to get higher. The propensity, and because we moved up so much, how far it can come down, can get bigger too. Once we catch up, right? Because we don't typically get this far above the 30-day moving average and come right back down to it. We grind for a while. That being said, the intermediate posture is about as bullish as it can possibly be. It's been above, this high 90s for multiple weeks. And obviously can't get to a strong bearish posture until you get below 20. So from 96 to 20 is going to be a while. So that's why I say you never go from strong bullish to strong bearish. You turn a weekly bearish, and then we meander, and then that weak bearish turns into a stronger bearish posture. Market sentiment's very high too, setting up for a divergence itself. It doesn't look so much there, but when you scale it out and give it some perspective, you can see we're obviously to much higher highs than we were. You can see back here in November is where the market sentiment peaked, so in that area there, and we're obviously to much higher highs now. So that divergence, in fact, the low point in between that divergence, you can kind of say would be, these lows here, where my cursor is. That lines up with the 23% Fibonacci retracement of market sentiment, as well as the 38 to 50% retracement lines of the current intermediate posture. So that would be the where we'd be looking for this market sentiment divergence to play itself out. Breaking below that level then would say, okay, now we're potentially got a longer bearish trend that we may be on. So that's kind of what we're seeing right now. Still got a strong bullish posture. Market sentiment still strongly bullish. So there's lots of these potential divergences, but nothing fulfilled yet. Near-term lines pulling back, so look for a pullback here. Don't look for a pullback all the way to 100%. That's unlikely on the first near-term pullback. Look for a near-term pullback in this area, and potentially a failure high where we fail to get a new bullish near-term high, and then then we'll get grind some more, maybe even a new a near-term low, bearish near-term low point where we get a lower low, and the near-term line gets into the lower reversal zone. So I'm not expecting it to be too bearish this first near-term drop. In fact, we still haven't really got the extreme low on the momentum line. We did here, and then we eradicated it. So until you get that extreme low point in the momentum line, not really expecting too bearish of a near-term low anytime soon. Of course, it'd have to get below that low where my cursor is now to get below the last near-term low point. So that's why I say just expect weak near-term bearish moves, and then expect a weak near-term bounce. And then that's when now we can say, okay, as we bounce up, we fail to get to new highs. Now things potentially could get a little bit more bearish to where we'll get a bearish intermediate trend. But even then, it would be a weak bearish intermediate trend. So hopefully you see a theme of how things can play out because we're so bullish, strongly bullish. As we turn bearish on the near term and then in the intermediate term and eventually market sentiment, it will be weak at first. So I know there's a lot of crazy articles about how high evaluations are and how things are just too far, too fast. Things have got to tank to come back to normal. Well, yeah, that's definitely the case. All that's true, but it doesn't have to tank tomorrow. It doesn't have to tank next month. It could be a year from now. It could be 2 years from now before we get the significant, falling off the cliff pullback. All right, quickly, let's take a look at the Dow Jones Industrial Average. And you can see similar posture, new all-time high for the Dow. Looking for the NASDAQ Composite, its near-term line has pulled down below 50. And look, that's what it took. So here's the last one. Same thing with the S&P. And that much of a pullback, which is 2 days worth of the same thing that we got there, that's all it took to bring the near-term line below 50. That's what I'm saying. Don't expect a big, significant drop. Not this far up above the moving average. And then finally, the Russell 2000, its near-term line had pulled back further. Now it's easily below the reversal zone itself. But again, that's all it took to do that. The posture is still strongly bullish. Market sentiment's almost back up above 80 again. Also setting up for the divergence, right? And the divergence would be down here closer to 1500. 1500 to 1520 in that area, that range there. So setting up for potential there. But again, when we're this bullish, it's hard to be too bearish, even in the short term. So don't, counter trend, try to fade these strong trends. Look for weakness for buying opportunities. And when you see the failure highs, which means new near-term highs that don't get up to new highs, they're lower near-term highs, then we know that, okay, this strong bullish intermediate trend, which has been going on the other indexes for months, is gonna turn into a bearish trend. And again, nothing too major, because nothing that would alter the long-term view, but more of a pullback than what we've seen. All right, you can see on this chart, we still got that potential for that long upper shadow on the weekly chart. Now, a reminder, we are, that the candle right now, if you look at the high to the close, it's about 13 points. The range today, if we were to take a look just again at today's range for SPX, we'll come back here to SPX. Here we go, 1 second here. Eventually, there we go. All right, so you look at today's range, it was smaller, it's a 17-point range. Yesterday's 28-point range. So we can get like a 15-point move easy. It wouldn't be that big of a deal. That's been the typical range here. So now we go back to that weekly chart and say, okay, well, if we get another 15-point drop, say tomorrow, for whatever reason, right? Just part of a near-term pullback, wouldn't even be that significant of a drop, but it would bring the close down to about 23.25-ish, 23.24, or 28.24, which would make that long upper shadow kind of double in size. And then the open, you see, is only at 28.09, so that means the candle will be bigger than the body. And again, that's bearish. And when you see longer upper shadows developing, that typically, especially that far away from the 50-day moving average, see another one over here, you see one right there, that usually leads to weakness in the successive weeks. So keep an eye. If we close at the high again next week, we're fine, right? A little bit of a bearish candle last week, but again, long lower shadows are not nearly as bearish as long upper shadows are. If we flip that around this week, to have back-to-back bearish candles that far above the moving average with a long upper shadow, then the odds of weakness start to really increase. Take a look at the 3 green arrows, and you can see again, the MACD is rolling over towards moving average. Stochastics rolled over towards its moving average. Neither one of them across, so it doesn't mean we're bearish. We're still pretty solidly above the 8-day moving average, and you can see just to pull it back down to that would get us to that 23% Fibonacci level, which, if you recall, on like the Nasdaq, which has brought that near-term line below 50. You can see that it's gotten closer, but still easily above its moving average, and the same thing with the Russell 2000, still above its moving average. So the near-term line, and this near-term pullback, basically has hasn't brought the MACD below its moving average, brought the near-term line below 50, but hasn't brought the MACD below its moving average, hasn't crossed below the 8-day either. Basically, just got down to it. So that's what you can kind of expect. Again, I don't expect this first near-term pullback to be too significantly bearish. Look for a failure high, then more of a near-term pullback. More potentially a bearish near-term low point, but grinding in this like 2850 to 2750 area, just kind of grinding its way sideways while these moving averages converge. So they have to converge first. You can see when you pull away, they have to converge. So we'll fiddle around. Really, we'll fiddle around with that 8 and 17-day moving averages while the 30 catches up. That's the typical pattern. Now, of course, anything can happen, so nothing's 100%, but that's the typical pattern that you look for. So don't try to be too aggressively bearish here if you think that this is the top for whatever reason. Because we can just grind away for a while, and for new bullish positions, especially option positions, that can be frustrating that we're not moving anywhere. So you have to make sure you find opportunities that have potential for movement beyond the rising tide, which is the broader market. The intraday chart shows an interesting pattern. Yesterday we had the outside day where the high was higher, the low was lower than the previous days. Today it's the opposite. It's the inside day where the high was lower and the low was higher. So all of it, both of those at the end of a move can be considered bearish. You can see how we're kind of tightening up. It's basically almost like a coiling action. Now, keep in mind, here's something to keep in mind about coils. Or another name for coils can be symmetrical triangles. Typically, the breakout of a triangle goes in the direction of the move heading into the triangle. So we had a move of bullishness heading into the triangle. This may be all the near-term pullback we get on this first one. Remember, we don't expect the first near-term pullback after a 4 or 5 month long intermediate run to be significant. right? It's the opposite on the other side. That first near-term run coming off of a low point, intermediate low point, tends to be pretty significant. Because volatility is higher and you got that first initial move. Not the case on the bullish move. So that might be it. We might break out of this to the upside. Whether we get to new highs or not, it's another matter, because you still got, to get above that high. We might still go sideways a little bit within this coil, at least early tomorrow. Now we have GDP out tomorrow. We have some things that can move the markets. But we might, if we don't get up to 284, 284.50, or we get a little bit above it and form a bearish near-term divergence, then that could now start to lead to more bearishness afterwards, which could be another 3, 4, 5 days away. So again, symmetrical triangle. Eventually, we will get a new intermediate low point. Eventually, it's sooner rather than later. But it's not gonna form tomorrow. It's a process, and hopefully I'm outlining and detailing this process to you so that you can say, okay, well, David says there's gonna be an intermediate low point, so I'm gonna get really bearish here and try to take advantage because it's how bullish we are, and hopefully you don't fall into that trap. Now, of course, we could tank for all we know. But that's not how it has happened in the past. Usually we just kind of grind. And if you're trying to really be bearish in a grinding market, then that, especially if you're negative theta, that time decay, you're buying options, that time decay is going to eat you alive while the market goes nowhere. Where you think it should go somewhere because of how bullish we've been. All right, now let's take a look at the daily chart here. Give it a second to load that up, see what the volume was for the day, dropping off sharply from yesterday down to 81 million, the lowest volume we've had in this volatile period here. You can also see the range just under 2 points, so 1.87. Let's put that in context. 1.87 is still pretty high. It's about where the average is right now, and the average is as high as it's been. So this is the biggest average trading range we've had in the last year. Right now, even during these, quote-unquote pullbacks, these intermediate low points that we formed here and here. Volume, what was the volume again? It was like 80 some odd million. 81 million. So that puts you about right there. So lower than the average, but still pretty elevated compared to where the 52-week range is for that average. And then now we look at volatility index, and you can see pulling back a little bit. But it was up today, and we're not really pulling back enough. It doesn't look like we're threatening to form a new higher low point. Now, we're also not getting a higher high either on the VIX, and we've already got one red arrow. We've already crossed below the midpoint on the MACD. Crossing below the midpoint on the stochastics would form would solidify that as a lower high point. But then the question is, where's the next low point? Could we be forming a triangle here that ultimately leads to a breakout to the upside and a similar move that we had heading into that triangle, that consolidation move? So this next pullback here, if we're going to be bullish for a little bit longer, we've got to get below 11 on the volatility index. If we don't, then look for a failure high. Look for that next near-term high not to be significant enough, and eventually lead to more near-term weakness. And eventually more near-term volatility leads to that bearish intermediate posture and a bearish intermediate low point that, like I said, we haven't had for 5 months. All right, now let's talk about what's driving the price action. And as always, I hit this spot to remind you to go to, if you follow me on Twitter, to like and retweet. That lets Twitter know that you engage with my content, that you want to see more of my tweets in your timelines. There's a link in the description down below on YouTube that takes you straight here, straight to that tweet. It's always pinned to the top of my timeline, but if you want to click on that link while you're watching, you can click there, hit that like, hit that retweet button, and you'll start to see more of my stuff filtered with all the other stuff that you follow, all the other accounts that you follow in your timelines there. And the benefit I get out of that, like I mentioned before, is the more engagement these tweets have, the more they'll push it out to all my followers. Make sure everybody's seeing that. All right, so I'll take a look at what's going on today. On the calendar, there wasn't a whole lot. We had jobless claims. We had a second consecutive day of some negative home data. And again, it's just 1 month, and it's still relatively high compared to where it's been. We had kind of an outlier. Maybe this last month's figures were an outlier. That was new home sales. This is existing. So you can see even this month here, the current data point is relatively high, and coming down from the all-time high, or the really strong high that we had in the previous data point. Jobless claims are still pretty strong. But regardless, what's happening now is this Citigroup Economic Surprise Index is a rolling 3-month window of economic data, and you notice it's falling. And we're not getting like sharply below estimates. Yeah, new home sales, existing home sales, they don't produce a lot of volatility, anyways in the currency markets, which is what this is based off of. And so what's the saying is we're starting to slow down on the really strong economic data, the much better than expected estimates that we were getting at the beginning of this 3-month window, because it's moving, right? It's a moving target. Things come off, new data comes on. And so what it looks like from this chart is what was coming off is that strong data, and we're really starting to slow down, and that's slowing down expectations for these rate hikes. This is December. You can see that the odds of that second rate hike in June jump back up again, but still kind of flat from where it's been. So you can see it jump back up, kind of stalling right there about that 50%. Same thing with the one rate hike that's widely expected now in March to occur. It's kind of flat too. So we're not getting, when that economic surprise index goes up, this goes up. These rate hike odds go up. When it starts to flatline or it starts to pull back, you notice we're starting to get, the odds, the futures market odds for rate hikes start to level out a little bit. So losing a little bit of strength there. When you look at the different asset classes and how they perform today, you can see that long-term bonds bounced. They've been dropping so much. The dollar started off the day weak. Then we got some comments from President Trump about, okay, well, hey, those comments about the weak dollar from the Treasury Secretary, it's actually the opposite. We expect the dollar to be strong, and the dollar got a lift out of that. So you notice here from the point that the dollar rallied up 3.75%. Look at gold and commodities in emerging markets. They've all really struggled on that strong dollar and pushed down. Now, keep in mind, for the dollar to get back to a strong trend again, you notice it's got to really move. Like today, we got all that bounce did at the end of the day is form a long lower shadow. Now, long lower shadows tend to be bullish, so that might mean that this impulse move that we have here, which impulse moves are moves in the direction of the trend, so this bearish move that we have in the direction of this bearish trend may be done. We may be starting to bottom out. Doesn't mean that we're starting a new bullish trend. It just means that we'll probably, we could bounce up in the near term up to about 91 and in a quarter in that area before we potentially form a new high point and roll back over and continue the trend. Because despite the comments from the administration, the market trend, the market is dictating a bearish trend for the dollar, despite all those strong economic data points, despite the fact that the Fed's rate hike odds are rallying. That hasn't kept the dollar from being bullish. And so we talked yesterday about what happens when the dollar goes down and the dollar goes up. When the dollar went up today, we had the opposite reaction. U.S. stocks outperformed international stocks. Gold and commodities were down. Emerging markets struggled, and the dollar was up and bonds were up. Long-term bonds were up. So it's almost like a flight to safety. Minus gold is almost a little bit of a flight to safety once that dollar move took off. So I zoom out today, and you can see another reason why the dollar bounced up and why, this a half a day of upward move doesn't make a new trend, because it just also happened to be the biggest loser of the last 2 weeks, down 3.5%. Go out further to the 4-week window, not the biggest loss. Give it a second to load up here. Actually, it is the biggest loss, down 4% over the 2-week period, and bonds are out. So again, this isn't necessarily like we're starting a new bullish trend for the dollar. We have been moving in this direction for 4 weeks for so long, for such a strong move, and especially after a gap down early this morning, that we're really kind of getting a bounce back move. Nothing more as of right now than a bounce back move, which means you'll get pullbacks in commodities, you'll get pullback in emerging markets, you'll get pullback in gold, bonds will bounce back up again, but all those strong trends are established in all those markets. Doesn't mean that those trends go away. All right, so now if we take a look at the sector rotation chart, and look from about the same, or what was it? When was the time frame that the dollar made its run to the upside? So right about at that 150 mark. So the last hour, it made that run to the upside. Actually a little bit earlier than that, because you can see when these things peak. So right about 110, that 110 mark there, right there is when we hit the low on that move and bounced up. All right, well, since that low point from the sector rotation standpoint, again, we'll go to 110 right there. And you can see there's the moves that happened, and from a sector rotation, you can see utilities, real estate both moving up really well. Technology dropping, energy dropping, materials dropping, industrials dropping, all these dollar sensitive areas. If I were to now zoom out to the 2 weeks, the 4 week pattern, and again, remember what's got the most to gain? Utilities and real estate. They've been negative in the period where the S&P's been up 6%. They've been negative. And that's not like a 2-day period. This is like a 4-week period where they've persistently been negative. So they've got the most to bounce up. Staples a little bit more too, because it's been lagging, but at least positive. And you can see on the upside, energy's been dropping the last couple of days. Technology's been dropping the last couple of days. Consumer discretionary has been holding up. Netflix has been holding up, among other big name areas, stocks in that particular sector. But all in healthcare holding up too. You can see healthcare doing really well. But materials, industrials, after doing really well, they've all, industrials, materials, energy, technology have all been kind of up here and had their turns at the top, and now they're all kind of pulling back and pretty much matching the market as a whole. Financials lagging, but healthcare and discretionary. And we talked earlier about, we have to, when the market's grinding, you see big movements here. These will all start to kind of gravitate back towards each other. When they diverge like this, then they will converge back down, usually to around somewhere in this area here. Everything will start to pull back towards each other, which means these will outperform for a period of time, and these will lag for a period of time. Not to change the trends, but just to converge these lines back towards each other as we grind on the broad market and let those moving averages kind of catch up with us. All right, for our trade idea of the day, again, with that theme of kind of looking for things that can move in a market that may not move for a while. And the stock you might have seen earlier in the video is First Solar. I have it pulled up here. And there's a reason why I have it pulled up. Let me show you first its current chart. And we'll go back to that longer time frame. First Solar has been doing really well. You can see it's been on a steady trend. It's on a current bullish trend right now. It got 3 red arrows and bounced there. It got 3 red arrows again here and has bounced after a couple days before where the tariffs were announced in the solar industry that helped it initially, pulled back down to the moving average, but bouncing back up today. And things. You can see when I look at the 2-line version, MACD still at around 0, potential to bounce up there. We've got that convergence. Now you look for a divergence. Same thing with stochastics, potential to form a bullish phantom green arrow on that. And then you take a look at like the market forecast indicator, a near-term line or intermediate line below 50. So turning back up above 50 would be significant for that, with the short-term sentiment improving. But it doesn't have to go up, because if I go back out to that longer time frame, you can see that we're approaching. We got earnings coming up too, and that could be a powerful mover. We've seen it move the stock before in the past. So, but you also notice as I pull up this 10-year chart for some perspective. There we go. You can see that we're pretty much at a significant high. 75, we've never gotten through. 75. The 50 days way above the 200-day moving average. It's been higher before when it first started to make its crazy run up to $300 a share. But 75 we hit in early 2016, dropped all the way down from there. We hit it in late 2014, dropped all the way down to there. So the question is, okay, well, you notice that when we're at this level, we can break through it, because that would be a significant resistance, multi-year, multiple touches. And that would be a significant resistance. We could really move, especially with that earnings helping to push through, or we could really come down. If you notice the last couple of times we've hit this level, here from this point down, if you see here, it's about 30, look at this days here, even just to get down to, about 45, right about that 50 area, it's about 56 days. And then from here to get down to about that 50 area was about 56 days too. So we've come down pretty sharply from these levels, and we were pretty bullish heading into that resistance, and we got pretty bearish pretty quick. So can the same thing happen again? Can we come down and hit that $50 within 6 weeks with 50 some odd days again, or are we going to break out and really make a move to the upside? And that's where this trade idea of saying, okay, well, let's look at, in this March window, it's 50 days out, let's look at buying an at-the-money call and buying an at-the-money put. So you notice here that we've got, and the options will be relatively expensive. They're not as expensive as if you were to go, you can see the volatility is at 54%. Here in this February time frame, you can see it's a little bit higher. So the volatility is relatively high. You're going to get a volatility crush out of this. But you notice that for us to lose $1,000, that $1,000, it has to stay at 70. That's where the odds of it staying at 70 in the next 50 days are relatively low because of the potential movement that this stock can make. It can really come down hard from that resistance, or it could really break through. So you say, okay, well, let me. How about another alternative here? If we were to make, so these lines here are at a 2 standard deviation move. What if we said, what if it got up to $100, made a 2 standard deviation move, a big breakout move to the upside? What if I were to say, okay, if I were to buy this 95 call option and sell this 100, I'm not going to pay very much money, but the potential reward for this, analyze trade, and take a look at this. The potential reward is an $18 loss, very, very minimal, for a potential reward of $482 if we get above 100. Pretty decent gain. Now, if I just bought the call option by itself, we get a similar return. So the 95 call option. If I just bought that, again, my loss would be $38 here. But you can see if I get to 100, my reward's about 450. See the green number in the bottom left corner of the screen over there? It's about $456, $460 in that area. So, but you notice that costs twice as much as doing the vertical. So we could do 2 of these verticals here. And you can see now, again, for about same loss as buying the put, or buying the call option for 38, now I can get a almost $1,000 reward. $1,000 for 38 versus $400. So about double the reward. That's a pretty darn good reward to risk ratio if we were to break out and make the move higher. Now you notice, if I did the straddle, the same thing happens. So if I get to that $100, look at that reward over there, and you can see now if I get to 100, and again, this is buying the put. If it get to 100, the put's worthless, right? We're going to lose money in the put, but we'll make money in the call option. We'll make more money on the call option being bullish. And now for $1,000 of risk, which, again, it's only at risk if we finish at 70, which the odds are lower because we've seen we either drop down to 50, which is where 2 standard deviations is, in a matter of the same time frame to March, or we'll break out of this strong resistance and make it, potentially make a decent move to the upside, because that's what happens after breakouts. So if we did that, then we've got the reward of about $1,800. And again, that's about double of what our maximum gain would be for doing 2 verticals. So you see now, it's a speculative trade because we're anticipating a big move, one way or the other. And considering that we're hitting up against a ceiling, and you've got this market that's kind of in crazy bull market mode, the odds are, especially with the tariffs that were announced, the odds are that we could get a pretty decent move to the upside. We've had a pretty decent move to get here, even before a couple days ago. There's a pretty decent odds we can break through to the upside. And if it doesn't break through the upside, this straddle gives me the opportunity to make about $900 or so if we drop to the downside. So I've got the potential for making twice as much money as this really speculative long vertical that's really cheap. I can keep my risk really small for a decent reward to risk ratio, but I can double the potential reward by putting a little bit more cash into it. And if it doesn't go up, I'll lose that whole money. I'll lose all that 36 cents per share. But if it goes down significantly, I can make money to the downside as well. All with my risk being $1,000, but the odds of actually losing $1,000 being relatively low, because the one thing we know that we've seen in the past is it doesn't stay around here. We've got significant resistance. It's dropped in the past. Can it drop again? If it breaks through that resistance, and when we break through significant resistance, you usually get a pretty decent move to the upside. So we're kind of banking on a big move one way or the other, and that it's not an easy setup, but that's the kind of setup you need to make this kind of trade. You've got a couple alternatives to do. You can buy a long call option. It's way out there, not so impacted by the volatility, the high volatility. You can do a vertical spread and also decrease your risk to that volatility change. Or if you're looking for the max reward to the upside, you've got the straddle to give you an opportunity as well. So 3 different ways, and that also gives you a potential reward if it doesn't make the big move to the upside but drops instead significantly to the downside. So 3 different ways to play, 3 different pluses and minuses, right, of what you prefer to see. If you want the maximum gain, the straddle gives you the maximum gain. If you want to manage your risk, then the vertical spread helps you manage your risk with a decent reward to risk ratio. And of course, the long call's got the cheaper commissions and other benefits that it has to it. So different things, depending upon what you value the most in terms of benefits versus risks, can tell you which of these strategies you'd rather employ. So to summarize, the markets are strong, obviously strongly bullish. We are starting to get some near-term weakness. Do not expect this current bout of weakness to be anything more significant than probably what we've already seen now. But also don't expect this current trend to continue at the same pace and an angle that we currently have as well. So start looking for more of that near-term volatility. Some more of those red and green ovals in the market forecast chart that you see here. Some more ups and downs and more failure highs where we fail to get up to new near-term highs, and potentially some formation of new bearish near-term lows as we kind of grind our way to these moving averages. Doesn't mean that everything's got to grind. There's still opportunities, and with today's trade idea, the setup, again, there's a pretty decent setup for a stock to make a big move one way or the other. With today's trade idea, giving you some alternatives as to how you can play a stock like that that's got such a potential to make a big move. So with that said, as always, thank you very much for watching tonight. Remember to subscribe, to like, and to comment to this video here on YouTube down below. Also remember to follow me on Twitter for more content. Like and retweet tonight's Market Outlook tweet pinned to the top of my timeline. There's a link down in the description that will get you straight there, as well as to join the Market Outlook community on Facebook. Again, another link down in the description that will help you do that. Have a great evening, everybody. We'll see you all tomorrow.